In a recent survey from Realtor.com, more than 6 in 10 home buyers expect there to be a recession in the next 12 months. And even with that, with a potential recession coming around the corner, nearly 1 in 3 said that that would make them more likely to purchase a home during that time. So as they're going through, they're expecting potentially lower interest rates, less competition, and potentially lower home prices. But what actually happens to home prices and to mortgage rates here in San Diego if we did go into a recession? That's what we're going to dive into today. And as always, I'm Chris Erickson, and we got a real estate crew right here in San Diego, and we would love to earn your business. So if you want to start that conversation, you got to reach out, call, text, or email, because we got your back when making the move here in San Diego. All right, so right now we have up all transaction home price index for San Diego going back quite a ways. We're going to focus on this recession in 1990, the 2001 dot-com, the housing recession of 2008, and then we'll check on the pandemic recession, which was very brief right here. So home prices, starting, this is not actual home prices, this is just an index, okay, where were home values compared to, that starting point. And all the recessions we're gonna talk about all had different things that did trigger them, from the 1990s, where we had high interest rates, we had a savings and loan crisis, going to the dot-com of 2001, going to the housing / mortgage crisis of 2008, which obviously you can see on here, home prices did drop quite a bit. But what happened in the 90s? You would think, okay, home prices maybe fall a little bit. So from where it started here in 1990 Q3 going down, you can see it didn't last too long until Q2, or right around Q2 of 1991. But home prices did continue to fall for a few years after that, reaching their bottom way down here in Q1 of 1995 and Q3 of 1996 before they did start their upswing again. So there was about a 6% drop during this time. And you can see, compared to the 2008 crisis, it was a lot different. But the next recession, it did something totally different. As we're going into 2000s, we're going to zoom into this range right here. And you're going to see that home prices actually continued to rise during the dot-com bust. Right here, as the recession started in Q2 of 2001, home prices just were kind of chipping away, going up. And you can see there was no drop after that, just continued to rise going into the bubble of 2006. And then during the next recession, actually home prices did something a little bit different. They actually started to fall right here in Q1 of 2006, started going down before the recession even hit. So right here in about Q1 2008, that's when we always say the housing bust. But as you can see here, it actually started a little bit in front of that, the downward movement in home prices. And this was one of the bigger home price drops that we have seen in years past. This is kind of the outlier. One of the biggest things that did cause this was from the lending standards and mortgages. And obviously all that did have a huge impact on home prices, as there were less sales, all that kind of stuff going on. And home prices from 2006 all the way down to where we hit the bottom, it was about a 38% drop. So about a 5-year period where home prices were falling. You got a little bit of flatness in here, and then kind of started back up, going back up in 2012. And then once again, just like the dot-com bubble, you can see this little tiny recession we did have here in 2020. And during this time too, in the market, there's a lot of fear out there. A lot of people didn't know what was going on, but this is one of the biggest times that people did have an opportunity to jump into the market before things got nuts in 2001, 2022. And from there, from about 2020 all the way to where we are now, you can see home prices have continued to climb. Now, what about mortgage rates during this time? So this top line here is the 30-year fixed rate mortgage average in the United States. These bottom dotted line is the federal funds rate. Now, the federal funds rate doesn't exactly control what happens in the housing rates, as far as, okay, the Fed drops rates, the 30-year mortgage rate is going to go down. It actually follows the 10-year treasury much closer. But this will give you a good indicator, because a lot of people are thinking, we go into recession, the Fed starts cutting rates. That's going to have a direct impact on the mortgage rates. But there's a few other things at play. So it looks like going into this 1990 timeframe right here, mortgage rates were a little bit higher than they are right now. Right now, we're sitting right around 7%, but it's been going up over these past few months with uncertainty. The 10-year treasury has been going up. So we have seen mortgage interest rates go up over these past couple of weeks. But starting here in June 29th of 1990, the 30-year fixed rate mortgage was about 10.15. And as we said, as housing prices did dip over those next few years, you could see it did continue to drop down right over here to about 6.81%. So it was a long trek. You can see the federal funds rate did drop during these times too. They cut it pretty good right in the middle of this recession, dropped it down a few basis points from about 8% all the way down to about 6%, and then continued slowly cutting until got down to about the 3% mark here. Now going into 2000, the dot-com bust, what happened with mortgage rates there? Once again, okay, you see we started in just February of 2001, and it did drop down going into the next few years as the federal funds rate did get down to 1%. Now during this time, we were kind of going down to about 5.4%, so much less than the previous recession, but you can see there still was a drop in mortgage rates here during this time frame. So when home prices started dropping in 2006, actually mortgage rates were going up a little bit here before the actual recession, peaking at about 6.8%. As we hit the recession, you can see where the federal funds rate, I mean, they just dropped it like a rock over these next few years right here, all the way down to just about zero. And over the next few years, you can see there was an initial, look at even this big drop right here in 2008. You can see the mortgage rates were actually kind of going up a little bit, jumping around a little bit. It's not a direct correlation. Like I said, federal funds, they cut. Even this time during this cycle, last year when they did cut, we saw mortgage rates go up a little bit. So there's not a direct correlation. Like I said, it has more to do what's going on in the 10-year treasury. But there was a big drop off here kind of towards the end as they did do their second round of big drops. And then over the next few years, as it did sit just at around zero, you can see the mortgage rates did drop going into April 2013, going down here. They remained relatively low for quite a while, right here sitting at 3.51%. And during this time here in San Diego, you could see that the home prices were starting to click up again. You can see more people were getting a little less with that uncertainty. So yeah, during 2008 to 2012, like I said, there was limited number of sales here in San Diego. There was a little bit, well, a lot bit different market than we have seen over these past few years. And part of that is due to uncertainty. Now, as they got to the bottom of that, interest rates were darn low at 3.5%. Now, I'll show you in a minute, they even went below that, which is why we've seen this recent boom. So now let's jump in to see what happened in the most recent recession here. It was very brief, right in 2020, right at the start of the pandemic. But going into 2017, the actual federal funds rate was on an uptick. So they were raising it, got about to 2.39%. During that time, interest rates were about 4.17%. And from that time, as the pandemic hit, you could see they dropped rates basically to zero, and interest rates dropped down very quickly to one of the lowest rates, maybe the lowest rate we might ever see, 2.65%. This is the time when a lot of refinances were happening. If you were in a 30-year fixed rate mortgage, even if you were at 3.5, 4, sub 4%, it did make sense to refi at this time. Get your payment down a little bit. Yeah, it restarts the entire length of the loan if you were doing 30-year mortgage, but it usually did save people money on their monthly payment. Now, during this time too, if you were purchasing a home, this is why we saw a huge jump in home prices during this time, is because if you could purchase a home and the rates were sub 3% for a big stretch of time here, that gives you a lot more purchasing power, meaning you can afford a lot more house. If you were bidding $25,000, $50,000, $100,000 over ask price, yeah, obviously it does add up. But if you're financing it for 30 years at sub 3%, it wasn't as big of a thing as if we saw that right now where we are sitting about 7%. So yes, during this time you did see mortgage rates fall, and then as the Fed started bumping up rates again, we're now back in this 7% range. So first off, what will happen if we did go into a recession? As you can see, it's really what was the catalyst of it and what's happening in a bunch of other parts of the economy. Is it housing related? Is it something else related? Are a lot of people losing their jobs? What's going on that front? So it's really hard to know. Obviously, sometimes prices rose, sometimes prices fell. But either way, a lot of things did happen, and there's going to be potentially less competition out there, which we have seen recently. I know we're not in a recession right now, but over these past few months, as interest rates have gone up above 7, we have seen less competition and just less buyers out there as a whole. Things as for sellers, homes are sitting for a little bit longer, and you're going to have to get everything dialed in as far as pricing, preparation, and promotion to get the home sold in a timely manner. So, as a buyer out there, yes, keep an eye on it. And just remember, okay, if you're one of the three that are potentially going to be purchasing or looking forward to a recession, and that might be the catalyst to get you purchasing a home, there could be some pros and cons to that. But if you guys did want to start that conversation and know everything you need to know about buying a home right here in San Diego, go check out our free home buyer's guide right there. Give you all the details from getting pre-approved to everything you need to know throughout the entire process of buying a home.